Okay, in this video we're going to continue on looking at the pro forma that we were developing. We're going to talk about the apartment building. We're going to add on the purchase and the financing. So let's go ahead and get started there. We'll jump to the spreadsheet and look through these things. We've already talked about the operations for the 240 unit apartment. We've done a 5-year pro forma. Now we're going to stick in the purchase price of $29.5 million, and we're going to look at the exit cap of 5.5%. That's the cap rate. That's going to give us a disposition amount of about $38.4 million because we're using year 6 NOI. So let's jump to the spreadsheet and take a look at that. So here's the spreadsheet we looked at the end of the last video, and this has all the operations. It has 5 years worth of operations, and we went ahead and did the 6th year because this NOI for the 6th year is what we need to find out the disposition amount. Let's go to this next tab, the property purchase with amortization. We have the assumptions up here. We're buying this thing for $29.5 million. That's a going in cap rate, by the way, of 5.39%. We can see what we're doing there. We're looking at the operations in the first year. So if we scroll down, oh goodness, that's in the operations tab, B40. B40 is the first year's NOI. So if we look at the first year's NOI and what we're paying for it, that's basically a 5.39 cap. That's the going in cap rate. And the exit cap rate is what we're selling it at. That's what this number is right here. It's based on year 6's NOI divided by the exit cap rate. So let's talk through this thing. We got some financing assumptions, 75% loan to value, interest rate of 5%, 25-year amortization. The annual payment is going to be calculated above. We figure out the monthly payment, annualize it by multiplying times 12. That's what's happening there at the very end of that formula. And so we've got our annual debt service payment. And let's look at what the returns are first here in this area for unleveraged, so no debt involved. We're buying the property for $29.5 million. We got the income, the expenses, and we got NOI for the 5-year hold. We're selling it for about $38.4 million. Again, that number is based on year 6's NOI divided by the exit cap rate of 5.5%. We get our row of numbers. This represents all of the cash flows for the property. And we can get an IRR for that, right? Just line up those cash flows, and then we can do an NPV, and this has the discount rate of 10% there in parentheses. And so I would take the NPV of all of the future cash flows, add back in that negative cash flow that represents the purchase price. If you wanted to use the XNPV function, you could assign some dates to these things. We just want to make sure that they're 1 year apart, and your NPV should show up very close to that number of $1,035,864. So that is the very simple unleveraged pro forma. Now what I want to look at is adding in the leverage. So let's scroll down here and try to keep in mind some of the assumptions. The loan proceeds, we're going to get the purchase price times the loan to value. So again, the loan to value is given up here, 75%. That's what that formula is doing, taking the purchase price and then multiplying it times 0.75%. And there is a flip sign in there to show that our proceeds are basically the bank giving us $22 million. So that flows down to the bottom line. Our net out of cash is $7.375 million. That's what we have out of pocket in terms of the cash flow for that purchase price. We have the gross income, the expenses, the NOI, and then we're going to take out of that the debt service payment. We calculated that above, and we have a couple of ratios that I want to talk about and look at. And this is actually in the slideshow. Before we do look at the numbers here, let me go back to the slide deck. So when we're talking about leverage in real estate, there's a few really important metrics that we keep in mind, and we've talked about some of these. The loan to value is simply the loan divided by the value. It's the most closely watched metric, and it gives a quick picture of risk. Banks generally want loan to values to be below 70%, 75% maybe for very safe multifamily projects. But the lower that number is, the safer it is for a bank, and they would like to see those numbers really low. That means it's a very safe loan for the bank to make. The debt service coverage ratio, sometimes called the debt coverage ratio, the DCR, but I like it, the debt service coverage ratio, is simply the NOI divided by the debt service. This is another important metric. We want to have a ratio above 1, and typically 1.2 would be the minimum for banks. And again, it's going to depend on kind of the state of the economy, how the appetite is for real estate lending at banks, etc. And then the last one, I'm not sure that we've talked about. Well, actually we did. We talked about this as the equity dividend rate in another in the previous chapter. A cash on cash return is the more common name for that, and that's just your cash flow after the debt service divided by your initial equity investment. So basically the cash you have invested in the property, you're going to see what kind of yield that you're getting on that cash investment that you've made. So this is something that equity investors also pay a lot of attention to. And let's just look at these calculations, at least the debt service coverage ratio and the cash on cash shown up here in the spreadsheet. So debt service coverage ratio, again, is the NOI divided by the debt service. You can see that formula right there. There is a negative sign to make sure that this is a positive number. It should be a positive number. It's never going to be a negative number. That would be silly. But starting off with 1.02, that would be a very low debt service coverage ratio. We probably would not get this loan, not be able to get this loan. But that's growing over time because our NOI is growing over time. Debt service is constant, but our NOI is growing, so we have this improving debt service coverage ratio. And then the cash on cash return, again, is the cash that we are generating after we've paid our debt service. So if we look down here, I'm netting out the debt service from the NOI, and that's leaving me about $38,000 in cash, and we're dividing it by the equity we have invested. So that's the difference between the purchase price and loan proceeds. I could have also referred to that negative $7 million down there at the bottom. Either way, we're dividing our cash that we're actually generating after everything is said and done. We're dividing that by our equity investment. So in this first year, we're only getting a 0.5% cash on cash return, which is extremely low. And it's tied to this very low debt service coverage ratio. If we had a 120, our cash on cash would be a bit bigger. But anyway, those are the ratios. Again, that grows over time. And we're selling the property, that same $38.382 million. We've got to pay off the loan. I've seen in some recent work that you've done that some of you forget to pay off a loan when you sell the building. That would be really unfortunate. The bank isn't going to let that happen. They're not going to let a property close before they get paid. So we got to account for the loan payoff to the bank. So here are the leveraged cash flows. That means we've taken into account the debt payments to the bank, the loan payoff, the amount of money that we get from the bank. Right, we're borrowing 22. After 5 years of making payments, we owe them 19.6. We got to take all that into account. And here are the leveraged cash flows, this row right here. We get a leveraged IRR by taking the IRR of those numbers. And then we have two different NPVs. The first one is the NPV using a 10% discount rate. I would argue that is inappropriate because we've layered on financial risk. That's part of the topic that we've been talking about in these video series. We've increased the risk for the equity investors by layering on debt. And so I would argue that the appropriate discount rate, which discount rates always reflect risk of an investment, should be higher. And in this case, I picked an arbitrarily higher number of 20% for the discount rate. We could argue about that, but it's definitely going to be higher than 10. Somewhere between 15 and 20 is probably appropriate. I've just picked 20 for the illustration purposes here. So doing the NPV with a 20% discount rate still leaves us with a nice positive NPV. So we would proceed with this project if we believed all of these numbers and all of these assumptions. So that is the kind of the baseline leveraged model. Again, just to recount what we've done here, we've used a 75% loan to value with a 5% interest rate, amortized over 25 years, and we've got to pay that off at the end of the 5th year. So we've amortized it down from 22 million to 19.5. We've paid, roughly, $2.5 million, $2.6 million towards the principal over those 5 years. And our returns are increased. Our leveraged IRR is 22.46. Our unlevered IRR was 10.84. And our NPV is still nice and positive even after the increased risk. So everything is looking good. What we're going to do in the next video is take a look at a different kind of loan. And that's another important part of this chapter, is looking at financing alternatives. And we're going to look at an interest-only loan. So that would be a loan where all you do is pay interest. You don't pay any principal amount. There's no amortization going on. And we're going to pick up with this tab looking at an interest-only loan, and we'll do that in the next video, and I will see you then.